Okay then. And so we've got Margot, Dimitri, and what's your name, madam? Aussie. Aussie. And are you looking to raise money as well? Possibly. No, it's not about healthcare. No. It's about raising equity money, equity finance. It's about raising funds. Raising finance? You want to raise finance for your business? Well, then you're in the right place. Well, let's see. Okay. But feel free to, if it's not right for you, feel free to leave. What I'm going to talk about a bit is the unquoted investment market. Might not mean much, but really what we're dealing is there's this sort of the different types of funding for different types of businesses. So as we say, the very early stage is the FFFF, which we describe as the friends, family, founders and fools that go in at the very early stage. And then after that, then we have the crowd, and the crowd is performing a bigger, more important funding source at the moment. Then we've got what we call the sophisticated investors, who are investors that are investing £25,000 upwards. So with the crowd, you can invest sort of £50. So as a matter of interest, have any of you looked at investing or raising money through crowd? And do you think you might do a crowdfunding? Right. I see. Right. Okay. And what about you, Dimitri? Have you? Yes, yes. Yes. Okay. So we're investors. We're very much in this sort of sophisticated investor space. So we think actually the crowd can be quite a good thing, and we think the advantages of the crowd, it can be quick, and actually for some companies it's good. The disadvantage is that all the information is in the public domain. There's not much confidentiality. You get loads of investors, and there can be problems with follow-on funding. In other words, if you want to raise money further down the line. We think it's suitable for the early stage small fundraisings, but I think you probably know that the companies need to manage their own marketing activities to try and send people to the platform in order to raise money. The pros and cons from an investor's perspective, and you have to think about if you're raising money, you have to treat the investor as a customer almost, in thinking, well, what does the investor want? So the advantages are they can invest sort of 50 quid. There's standard documentation, good, and basically you can do it's a bit of fun. And so from the investor perspective, it can be quite a good way of. You're very welcome to come on board if you want to learn about equity funding. We're having a little private session here. The disadvantages from an investor's perspective is it's quite high valuations, because valuations is one of the main things. How are you going to value your business? If you're going to raise £100,000, how much of the business are you going to give away? Are you going to give away 5% or 30%? And that's to do with how much you're going to value your business. Also, there's the potential for deal manipulation. This is something that's becoming increasingly concerning with the crowdfunders, is that people are actually, it's not really the crowd that are raising money or investing, it's more people that the company knows. And it's quite a complicated thing here, but there can be some manipulation of the market which can concern the investor. And it's more risky and less ongoing monitoring of deals, but I can cover more of that. Does that make sense? Do you understand the crowd from an investor's perspective? So what are the most common reasons that investors reject proposals? Well, we think we can say what the wonderful things are about how about the successful ones, but you learn probably more from the ones that aren't successful than the ones that are. So these, I won't sort of read through them. The too complex thing is sometimes we get companies where they say, actually, I want you to invest, I've got my brand and idea in this company, I've got another product over here, and the IP, the intellectual property, is held somewhere else. So actually, it's quite a diverse and quite a complicated structure. So what investors like to do, they want to invest in the top co, they want to invest in the main company. So would you like to come down? We're having a bit of more of an informal, because of the massive demand of this, we're expecting another 200 people coming along to this. No, they're not particularly well advertised. Well, we've got a nice small quorum of 4 here, so we can continue with that. Yeah, exactly. And we're dealing with equity. So we're dealing with equity funding and how it compares with the crowd and things like that. Our experience is raising £500,000 to £2 million for companies, and we deal with the investors who invest a minimum of £25,000. And as this guy said, there's plenty of money out there, and there is plenty of money out there, but only for the right deals. And we get probably 100 business plans a month, and we do about 2 to 3 deals a month. So you can sort of see what's happening in this market. And one thing you've got to think about also is the difference between the sophisticated investor and the VCs. Now, I imagine that you're probably too early for VCs. What about you, Paul? What's your? Are you looking to raise equity finance? You're a business advisor, so you might have other companies looking to raise finance. Okay. So I think you'll... Yes, Margot. Question from the floor. Margot. Yes. There are exceptions. Okay. Well, there are always exceptions, and I'm glad to speak about that. Gentlemen, are you interested in coming to the Raising Finance? If you want to come down here, we're having a more of a select... Okay, you can take pictures. Some like to come in at the beginning, but not many. And normally it's people that you know, the friends, family, founders and fools, dare I say it, that will come in at the very early stage. Gentlemen, if you want to find out more about raising equity finance, we're having a huddle round here if you want to come and join us, and you can feel free to come and go if you wish. We're talking about raising equity finance. You haven't missed much. Actually, you've missed quite a lot, really. You've missed all the gems, but I'll repeat them at the end. We're expecting another 200 people here, we say, apparently. So what are investors really looking for? Well, we say that investors are looking for 3 things. They're looking for a great management team, a great business, and a great deal. And what a lot of the companies haven't thought about is what they're going to offer their investors. So what the investment offer is. So the management is probably key. And our investors, they probably invest more on the individual. They prefer to back a really good team with an average idea rather than an average team with a really good idea. It's all about the people. As our investors, who are typically investing up to £500,000, they invest in £25,000 chunks, and they probably we get 100 business plans a month, and we do about 2 to 3 deals a month. The management, the business. So we're looking for scalable businesses which can knock the socks off and actually make a lot of money. In other words, making 10 times the investment over a 5-year period. And that's going to be one of the main things that investors are going to be looking at. The other thing is the exit route. The biggest concern with our investors is that they put money into your wonderful and exciting businesses, and they have no control, and they don't know when or how they're going to get their money back. So looking at the exit route is a very key part to when you're pitching to investors. You've got to treat them as customers and say, this is how you are going to get your money back. If you invest £100,000 in us, I'm going to give you back £500,000 in 4 years' time. And the most likely exit route is through trade sale. In other words, you're going to sell it to somebody else. And the deal has to be investment ready. And so you have to have a proper sensible deal. So if you have a business plan that says all about how wonderful your business is, actually you've got to say how wonderful the investment is. And the next thing is about EIS. Can I have a show of hands who knows what EIS is about? We've got a few, little spattering. So I'm going to give you a 30-second lesson about tax, which is I'm going to make as exciting as I possibly can, and I'm going to do it in a minute. So this is what we're looking for when our investors are investing in companies. We're looking at something that is out of the garage and a little bit further down the line than just a business idea. We get about 100 business ideas and business plans a month, and those are quite difficult to get much interest from investors. You have to think about how you're valuing your business, and I'll come on to talk about that in a minute. Full-time management team. You can't say, well, actually, I'm doing a bit of this and a bit of that, and I'm a director of this company, and I'm going to be doing some consultancy on the side. The other thing is getting a proper board of directors, a chairman as a non-exec director. And actually, that's probably one of the key things that an individual investor will look at and say, well, who is the board? If we have someone and gives us their business card and it says founder, chairman, CEO, everything, it's not going to be very conducive to raising funding from. Has we got anyone who's got that on their business card? I bet we probably have. I'll come on to more of those other things. So we get, as I said, we get about 100 to 150 business plans a month, and we're entrepreneurs and investors ourselves. We get very excited about business, but we get lots of things which don't quite make sense. And one of the main things is valuation. People think that their little scrap of paper is worth £2 million, where actually it might only be worth £200,000. And I'll come on to talk about that again in a minute. And there's loads of things that you need to think about in treating your investor as the customer to make it attractive and appealing for them. So the investor perspective. So this is what happens. Let's say you've sold your companies and now you are investors. You're going to invest £100,000 into various companies. Statistically, half of the deals are going to go bust. And you've got a 10% chance, or a 1 in 30, or as they say, it's a 3 in 33 chance of backing a winner, because most of them will lose, and most of them will go bust. So you have to think about it from the investor's perspective. So why are they investing? They're investing so they could have the chance of making a lot of money. They've got their investments in property, in stocks and shares, which is earning them 2 to 5%. They're looking to invest into young companies like yours with the potential for making spectacular gains. As an example, we've just had one of our investors who invested in a company called Parking Eye, which did vehicle number plate recognition. So, he invested £180,000 10 years ago. The company was sold for 50 million. That investor made 77 times his money over a 10-year period. Those are the ones we really like. We've made around 200 investments. We've had about 40 involuntary exits, as we call them, i.e. the business went bust, and we've made about 20 which are going really, really well. So this is the reason for not investing. This is the biggest complaint we have from our investors. The fact that once they put their money in, that's it. They don't hear anything about it from the company. The company needs to treat the investor like a customer. They don't give them any communication. They say they're going to give them quarterly management accounts, but they never do. And it's an illiquid stock. So we've got these investors who say, right, I'm going to put in £25,000. If they put that into the stock market, they can probably get it out in a week. They've got to wait for 4 to 7 years before they get their money back. And that's what the biggest problem that a lot of our investors will face. So, tax. Now, I'm going to keep this very simple and quick. If you don't know about EIS, you need to know about EIS. And in fact, what I'll do, I'll start off with SEIS, which is a seed EIS scheme. If you're an investor, imagine you're an investor now rather than a company. For every £10,000 you put in, you get a cheque back for £5,000 from the government. So you're actually going to be investing £5,000. If the business goes bust, if you're a 45% taxpayer, you get another £2,000 back. So you're actually only risking £2,750. So you're only risking 27.5% of your investment. So that's why if you are looking to raise equity finance from private investors, you need to get SEIS and then EIS tax clearance. So this is only for very small companies, their first round of funding. The maximum you can raise as a company is £150,000. And a maximum you can invest as an investor is £100,000. So then there's the EIS, the Enterprise Investment Scheme, which is a bit for slightly bigger companies. For every £100,000 an investor puts in, they get a cheque back for 30 grand, and if it goes bust, they get more back, so they're only risking 38.5. And if it doesn't go bust, it's free of capital gains tax and inheritance tax. So you need to be a quick expert in EIS and SEIS if you're looking to raise equity finance from investors. Going wrong way. Valuing and deal structuring. This is going to be a very exciting bit as well. The first thing you need to know is the difference between pre-money and post-money. When you say what your valuation is, you've got to think, well, is it pre or post-money? Most people deal with pre-money. So you've got to say that how much is your business worth at the moment? It might be £500,000, or you might say it's worth £2 million. If you say it's worth £2 million, you're probably not going to get any interest at all. You need to think about how you're going to be valuing the company. So how do you value your company now? So there are loads of ways you can do this with the wonders of Excel and spreadsheets, with great graphs and great things about how you're going to be selling £5 million in 4 years' time, making £1 million profit, discount it back, have a ratio of 10, so that's why I'm worth £10 million now. And so there's all these sorts of things that people look at to how they value their business. The real valuations, what people will look at are these sorts of things. Well, how much investment has gone in to date? And that can be cash investment. You can also say that you've worked for 2 years without taking a penny and all that sort of stuff. But the main thing that an investor will look at is the amount of cash that's gone into the business. So if you put in, or you and your family and your friends have put in £50,000 to £100,000, that's going to be a great thing to support your valuation. The replacement costs. We had one company which had an IT software business, and they developed a very good bit of programming and a CRM tool, and they were valuing themselves at £1 million. And we had a number of investors saying, well, actually, I could build that myself for probably 50 grand, for £50,000. Yet this person here is valuing it at £1 million. Doesn't really work. The perceived risk, the earlier the deal, the more risky it's going to be. The potential upside, but the main thing is market valuations. In other words, what other deals similar to yours have raised money? And here are just some examples. So we had an HR software company, which was pre-revenue startup. Their pre-money valuation was 300 grand. They raised 150,000, which means their post-money valuation was 450,000. So they had to give away 33% of the company. And we've got various other examples of what these valuations are and what valuations have actually occurred in deals that have been done. And this isn't very sophisticated. The higher the valuation, the less interest you're going to get. So you need to think about how you're going to be valuing your business. So I'm just going to give you 2 slides about investors. We've been going for 10 years. We've got around 2,000 sophisticated investors and family offices. Typically, the average investment per individual is £40,000. The average fundraise for a company is £500,000. And we've invested in around 200 companies at about 78 million. We used to slag off this award as being totally useless and meaningless because we didn't like awards, but then we won it, and now, of course, we think it's a very important recognition of how good we are in our industry. We have offices in London, Jersey, Monaco and Dubai. And this is who we are. Our chairman is a guy called Kevin Lomax, who started Mysis, and that was a FTSE 100 company. We've got quite an active board who invest. We've got a full London team, and we also have offices in Jersey, Harrogate, Monaco and Dubai. So we've got a very active investor group of people looking to invest. So I think that's it. What I'm just going to do now is just going to go back to the very beginning for those people that weren't quite here and just sort of explain. So this is where we're dealing in the market. So we're in the sophisticated investor market, and we're sort of above the crowd. So the crowd we think is very good for smaller deals up to 150 to 200,000 pounds. We're in the next stage after that of companies looking to raise sort of 200 grand to 2 million. And I went through the pros and cons of dealing with the crowd. So can I ask, is anyone on a crowdfunding platform at the moment with their deal? Is anyone, who here is looking to raise finance for their company? Put your hands up. Margot? None of you looking to, are you all investors then out there then, perhaps looking to invest? Dimitri is considering investing, because we only had 2 people to start off, that's why I got to know these 2 people. Right, do we have any other questions from the floor? And I can talk about anything to do with raising equity finance. Otherwise, it's all crystal clear, is it? Well, it's not crystal clear at all, Margot. Well, you can come and chat to me afterwards. If anyone wants to... Yes, we have a question from the floor. So particular sectors, or what are hot sectors at the moment? Generally speaking, I'll just put my, Generally speaking, we like product and service innovation. So we like software and tech companies. We do some med tech, in other words, medical, but it's IT, software, and product and service innovation. So in other words, it's something which is a new product or service which is answering a big problem, which is defendable, and so it's not going to be loads of competitors coming in, and it's got the ability to massively scale, and we're looking for really good entrepreneurs and really good teams. So do I have any other questions from the floor before I go? Otherwise, you're welcome. So the other thing we do, we have this, which goes out every 2 months, and this has a number of deals in it, and actually if anyone's interested you can come and take one of these, and this gives you an idea of the deals that we do. So this is the September-October bulletin, and it's got 8 deals, and it will give you a flavour of the sort of real deals that we do. Do we have any other questions from the floor? Otherwise I'm very happy to take questions individually. What a knockout crowd you've been. Thank you very much indeed.